This is a time of great opportunity for BHP. The resources we produce are essential to the energy transition and global economic growth. Our products are fundamental to the way we live now and into the future. Now more than ever, we need to provide the world the resources it needs responsibly and sustainably. Imagine what we can achieve if we continue to think big.
Hello, this is Rick Rule for Sprott Inc. Delighted to have the opportunity to address the IMARC audience. I, like most of you, wish that we were doing this in person. Being able to interchange after the presentation, perhaps if I've driven you to drink, sharing a beer, but such is not the case. We're doing the best we can with what we have. In some senses, perhaps better for all of us, not having to travel as far, endure as many indignities at borders, and perhaps it'll even cause us to drink less, who knows. At any rate, I'd like to thank IMARC and their wonderful employees for all the live conferences they've put on over the years and for their valiant and thus far successful efforts to bring their wonderful live franchise online. And further, thank you, ladies and gentlemen, all of you who have reached out to me after various live IMARC conferences over the years, and particularly those of you who have done business with Sprott as a consequence of those interactions. I've been asked to talk about the impact of the COVID-19 virus and perhaps the policy responses to the virus on demand for minerals, metals, and mineral and metal related investments. I need to begin with a few caveats. In the first instance, I'm not a virologist or an epidemiologist, or even, frankly, an economist. I'm merely a credit analyst and a speculator. So please understand the level of expertise that's involved in making these remarks. I would suggest, at least from our point of view, that the impacts associated with the virus need to be broken down into several components, including, of course, the long-term impacts and the short-term impacts. But I do think that they're very important to consider. I also think in a very broad sense that we need to think about the impact of the virus and a possible vaccine for the virus on the one hand. And we need to think also about the impact of the policy response to the virus, which I suggest will ultimately be more important to our industry in many regards than the virus itself. So let's take a shot at this. First of all, a self-congratulatory shot. I think the operating companies in the mining business have done an exemplary job in occupational safety and health aspects around the virus. Yes, we've suffered some closures worldwide, and we've also felt some health impacts on our employees. But those impacts were nowhere near as severe as I, as an example, thought they would be, nor were they anywhere near as severe as other people would have suspected, given that we put a lot of people in narrow and confined spaces. We often transport them to the work site together, bring them home together in remote locations. We put people closer than ought to otherwise be the case in terms of a response to the COVID-19 virus. But really around the world, where we have needed to shut facilities to protect our employees and our communities, we've been relatively successful at doing that. And we have been able to protect our employees too, that we're able to continue to work at places as different as a construction site in the Congo, operating mines in Latin America. The industry, I think, has done an exemplary job and should be congratulated for that. But let's move back to the task at hand. In the very near term, my suspicion is that capital markets are going to experience a relief rally that will take place really as a consequence of three things. The first is simply that as concerns about the virus begin to fade, or at least concerns about how the economy might deal with the virus begin to fade, pardon me, particularly if the early results of efficacious vaccines prove to be accurate, that sort of rebound in sentiment combined with artificially low interest rates, low cost of capital, I think might set the stage for a near-term equities market and perhaps economic rally. And one would expect that given that resource stocks, or at least in some measure stocks, that might be beneficial for public equity markets in natural resources and in particular in precious metals. We'll visit with the longer term part of that discussion in a minute. But I think separate and apart from the impact of the virus itself, precious metals investors in particular need to consider the effect of the policy response to the virus. It would seem that the voters in virtually every democracy around the world, and hence their political leadership, believe that the cure for any sign of economic or social distress involves a cocktail of quantitative easing. By the way, if you and I conducted quantitative easing, it would be called counterfeiting. We would be put in prison. But if the government does it, it's called policy, and it makes them very popular. Fiscal measures, which is to say debt and deficits, and importantly, artificially low interest rates. The policy response to the COVID virus from a government perspective was the same as the policy response to the 2008 financial crisis, which is to say lots of easy, cheap money. It has been my own experience over 45 years of investing and speculating that during periods of time when investors and savers were concerned about the impact of the purchasing on their purchasing power, pardon me, in conventional savings instruments, particularly those denominated in fiat currencies, and more particularly the US dollar, that the gold price did well. And my suspicion is that the ongoing policy response to the COVID-19 virus and every other thing that appears to ail the voters will involve quantitative easing, debt and deficits, and artificially low interest rates. And all of those, in turn, will undermine faith in the purchasing power of conventional savings instruments, and as a consequence, all of the above should be good for precious metals prices and hence precious metals equities prices. One shouldn't expect stair steps to heaven, of course. That's not the way precious metals bull markets work. This is a business that can have extraordinary volatility in a secular bull market. And I think we're seeing just exactly that as we speak. But my suspicion is that one of the outcomes of the policy response to the COVID-19 virus will be a continuation, and probably a continuation for a substantial period of time, in precious metals prices and hence in precious metals equities prices. With regards to industrial materials, I think the outlook is much less clear. My own particular view of the economy, with the caveat that I'm not an economist, is maybe less rosy than that which is exhibited in other parts. I believe in the first instance that the recovery that we enjoyed post-2008, which is to say 2009 to 2019, was a 10-year-long recovery. And I would argue with you that that recovery was driven as much by overly abundant capital and by surplus liquidity as it was any increase in global trade or any increase in efficiency or productivity, which is to say that the rally that we enjoyed was both longer than we have learned to expect historically, and also particularly, at least partially, artificial. And as a consequence of that, it wouldn't surprise me at all to see the need to digest the gains that we enjoyed in the 2009 to 2019 economic rally. Now, the trigger for that, obviously, may have been found in the economy's response to the COVID-19 virus, which was to say, to shut down many important industries. I'm not certain myself that the total economic cost of the COVID-19 virus has been reflected, as an example, in either debt or equity markets, which seem to have continued unscathed. My fear, I guess that's the right phrase, my fear is that the global economy will be weaker for longer than other people suspect it might be, both as a consequence of a normal recovery that one might expect from a 10-year-long rally, and also as a consequence of truly digesting the economic cost of COVID-19 and any repercussions, health repercussions that might have. If I'm correct, that the global economy is slower to recover than many people suspect, one would expect the prices of industrial materials, things like copper and iron and oil and gas, to be slow for some substantial period of time. Now, in fairness, I've been afraid of this for 6 or 7 months, and mercifully, I've been very wrong. Iron has been in a tear, and copper have been in a tear, respectively, which would suggest that the prices of those those commodities, means that the market itself fears those circumstances less than I. That notwithstanding, I continue to believe that one should plan for a period of prolonged economic weakness. And in some senses, that's good news. I know that the idea that that's good news will take some getting used to, but I'll try to make that point in the time I have left. It's my belief, actually, that resource investors in the next 5 to 7 years will enjoy not one, but 2 bull markets, although those markets will be offset in a sense. I believe that we're in a precious metals and precious metals equities bull market right now as a consequence of the policy response worldwide to the virus and other economic ills, as I've discussed. And precious metals bull markets tend to be of substantial duration, like 10 years, and substantial dimension. And I don't think that this one is over by any way, shape, or form. I believe that a period of weakness in industrial materials, energy, and base metals prices will lead to a continuance of an underinvestment in productive capacity in those industries, both sustaining capital investments and new project investments. And coming on top of the underinvestment in those sectors that we've seen for 10 years, my belief is that in the out years, and I can't be more specific than that, 2013, 14, 2020, 23, 24, 25, at some point in time like that, the industry begins to experience, or those industries begin to experience, fairly severe production shortfalls as a consequence of underinvestment in productive capacity. And I think that sets the stage for commodity price rebounds, perhaps on the order of the bull market that we all enjoyed so much in the 2000 to 2006 timeframe. I know you wanted a very simple 30-second one-size-fits-all answer to the impact of COVID on metals, materials, and metals equities. But the truth is that the answer needs to be more subtle than that. Perhaps a near-term relief rally. Certainly in the longer term, I think the whole economy needs to digest the impact of the virus on the economy. But people need to understand too that the policy response to the virus and to other economic ills will be very good for precious metals and precious metals equities. Ladies and gentlemen, thank you for the opportunity to address you, albeit on a fairly grim topic. I look forward to seeing you at other IMARC online and someday IMARC live events. Once again, as always, thank you for your attention and please stay safe.